Most people treat a bank account like a vault. You put your money in, lock the door, and assume it's perfectly safe. But mathematically, inflation guarantees that hoarding cash will actively reduce your wealth. The purchasing power of that currency slowly melts away as prices rise. This graph shows a typical life cycle of income and spending. Saving describes that specific period where income outpaces expenses, allowing you to accumulate highly liquid funds for immediate short-term needs. Speculation represents a different trap. It involves chasing short-term profits through market momentum or price swings, rather than conducting any fundamental analysis of what the asset is actually worth. True investing requires a deliberate choice to defer current consumption. By committing funds to long-term assets, you aim to capture greater returns at a later date. Since saving loses value to inflation and speculation relies on luck, wealth generation requires a systematic method for calculating and capturing growth. The entire financial ecosystem is driven by a single relationship. Risk leads return. The reward you can expect is a direct result of the uncertainty you are willing to accept. This logic forms the required rate of return, the absolute minimum profit an investor expects. The equation starts with the real risk-free rate, which is the baseline price for simply locking your money away and postponing your ability to spend it. We then add expected inflation to the equation. This ensures the investment maintains its baseline purchasing power as the general cost of living increases over time. The final critical variable is the risk premium. This represents the mandatory compensation an investor demands for stepping into an uncertain outcome. That risk premium accounts for specific threats, including business risk, where a company fails to generate profits, credit risk, where a borrower defaults, and liquidity risk, where an asset cannot be sold quickly for cash. This calculation allows an investor to decide if the potential reward of an asset justifies the specific risk premium required to own it. Market participants use different tools to satisfy these risk-return objectives. Fixed income securities, like bonds, provide predictable cash flows and prioritize capital preservation, which results in a lower risk profile. The equity markets operate differently. Buying stocks gives you a residual claim on a company's profits, making equities the primary engine for capital appreciation. However, that ownership brings significantly higher price volatility. Real estate, commodities, and alternative assets provide further diversification, allowing an investor to manage the overall risk premium of their entire portfolio. Asset classes function as precise instruments, used to adjust the risk premium of a portfolio until it aligns with a specific financial objective. Understanding the math is only half the battle. Executing this strategy flawlessly over decades requires continuous research and the emotional discipline to remain focused during market fluctuations. Some investors use the direct channel, buying securities through a broker. This provides control, but also means the individual must personally manage every operational detail and risk assessment. Others use the managed channel. This delegates the complex risk-reward mathematics to regulated professionals who handle the investment process on the investor's behalf. The choice of management channel often determines the long-term success of the investment strategy. These professional vehicles are tiered based on investor needs. Mutual funds pool money from millions of people to provide broad diversification and economies of scale for retail investors. This questionnaire illustrates the intake process for portfolio management services, or PMS. By weighting factors like income stability and loss tolerance, a PMS builds a highly customized strategy tailored specifically for high net worth individuals. Specialized vehicles known as alternative investment funds, or AIFs, are used to access non-traditional assets like private equity or distressed debt. This structured approach to risk, return, and professional oversight creates a calculated architecture for wealth. It protects the value of your labor today so it can provide for your future tomorrow.